Today's video is pretty straightforward because I hit a major goal of mine this week. I added one whole figure to my dividend income. So now I'm sitting at $100 per year. Let's talk about how I got there. It all started on July 21st, 2019 when I downloaded a little app called Robinhood and got a free stock of Fitbit worth $4.33. Okay, we're not going to get into that much detail on every single move I've made since I started investing, but that is when I actually started researching, started learning about how to invest, what to invest into, and I know $100 doesn't seem like that much, but you need to hit $100 a year before you hit $1,000 a year. You need to hit $1,000 a year before you hit $10,000 a year. You get the point. So when I actually looked at my dividend income and realized, oh, I have $100 a year coming from all this. That's pretty neat, because one of the ways I'm working toward financial freedom is through dividend investing. So when I, again, looked at that income that I was getting, it just kind of reiterated that this is a good idea for me and this is starting to work. Let's get into some numbers, because I think a lot of people don't think how much money you actually have to invest to get a significant amount of money every month or every year in dividends. So this is just what it looks like for me with how I've approached it and getting to that $100 per year. So far with Robinhood, I've invested $2,409.91. This total at the top here, $2,483.78, includes that cash that I have not invested yet. So if we take that cash out of the total there, we get our $2,409.91. The other app I use is Webull, which I don't have as much invested there, but I have $333.14 there, which brings our total investment up to $2,743.05. Math. I've invested in a couple other companies as well that don't pay a dividend, and that first one I got from Fitbit, they don't pay a dividend as well. So if we subtract all that out, we get our total dividend portfolio being $2,645.08. That $2,743 isn't quite accurate because I have played around with fractional shares on Robinhood and invested partially in companies that don't pay a dividend. For example, I've played around with FANG, which is our Facebook, Amazon, Netflix, and Google, the big players in the tech space. I also mixed them all together to add some tea, a little bit of Tesla. And you can't have tea without a little bit of sugar, so I invested a little bit into Berkshire Hathaway. So if we take all those out, our total dividend paying portfolio is $2,685. Unfortunately, due to everything that's going on, I had that $100 a year in dividend income, and then it dropped below it because I had 3 companies cut their dividend, which brings us to an important point when dividend investing is that companies are not obligated to pay a dividend. So at any point, for really any reason, there doesn't need to be a global pandemic, you can lose some of those dividends. So the strategy that you choose, who you're investing in, is very important. It's so important to do your research. For me, my main goal right now is investing in these dividend aristocrats. If you don't know what a dividend aristocrat is, it's companies that have consistently increased their dividends for 25 years. Because if they're continually doing that, that went through the 2008 recession, that went through the dot-com bubble, all those different things happened, and they've still increased their dividend. Which leads us to my portfolio, which I'm naming the Beanstalk. Pretty clever, right? Right? As of today, I have 39 holdings, just a mixture of ETFs and individual companies. And there's probably people that think even having 39 is too many companies to be invested into. The general rule says to invest between 15 and 20 companies because it's just easier to manage, easier to see how they're doing. But I'm still learning this. I've just found companies that have a solid dividend and a solid balance sheet, bought a share here, bought a share there, and I've ended up with 39. Farming metaphor. You want to have a large plot of land so that you can have a large harvest. So you're going to spread out, prepare that large field before you start building up. Make sense? The other strategy is to invest all your money into one company so that when you get those dividends, it's a higher dividend and you can reinvest that dividend back into the company and it'll grow quicker from there. My thought is that I'm still reinvesting those dividends, so I'm getting all these dividends from different companies. I'm still reinvesting them. I might reinvest them in the same company, but I also might save those dividends to reinvest in another company. So with my strategy, I'm getting a small position in a lot of companies, making sure I'm very diversified, which is kind of a pillar for a lot of people, is making sure you're not too invested in one sector. And then from there, once I feel like I have a good amount of companies and I'm diversified, I'll start adding more positions in these different companies. Maybe I'm an idiot. Let me know in the comments if I am. But again, this is just kind of the strategy I'm running with. We'll see if it works, but it's led me to this point so far and seems to be playing out in my favor, so I'm gonna keep running with it. Let's dive a little deeper into the portfolio. Right now I'm using a program called Simply Safe Dividends, which is basically a spreadsheet. It costs like $400 a year, but they do offer a 14-day free trial. I'm pretty cheap, so I'm in that 14-day free trial, and I probably won't spend $400 a year on it. I'd rather just invest that, but for the purpose of this video, it does look pretty clean. I'll leave a link in the description below if you do want to give it that 14-day free trial. So first up is the main thing we're looking at in this video, which is my yearly dividend income. And as you can see, this first box here, it is $105 per year. If we click into that, it breaks it down more with upcoming payments, and then it gives you a monthly breakdown as well. My monthly income ranges between $4 and $14. The big months being June, September, December, and March. Most of the companies that I'm invested in are on that quarterly payment schedule, and it looks like most of them are on the same cycle. So every 3 months, I get a little bit more in dividends. But again, at the bare minimum, I'm getting $4. So the whole point of this portfolio is to start replacing some of the expenses that I have. I know $4 might not be a lot, but it could cover a streaming service. As it grows more, it could cover your energy bill. As it grows even more, it could cover part of your mortgage. So starting to see the fruit of that, it is pretty cool that I'm starting to make some money back and that it's covering some of these expenses. So when I do get money from my job, it can go towards savings or it can go towards something else. The second number here we're looking at is the balance and performance, which again, so far I've invested $2,685. That does not include the stocks that don't pay dividends. I didn't add them to this just to keep it focused on those dividends. So if we break down how much I've invested per month since I started back in July, it's right around $268.50. We'll touch on this at the end. I haven't focused exactly on investing $268.50 a month. Some months I've been able to invest more, some months I've been able to invest less, but again, we'll touch on that at the end here. The third number that's very important to look at is the dividend yield. Right now my portfolio is at 3.91%. So dividend yield is how much a company pays on a per share basis to its shareholders. So if a company has a share that's worth $100 and they have a 5% dividend yield, you take $100 times 5% to get how much you get in a dividend payment per year. So for me, since my portfolio is $2,685, we take that times the dividend yield, which is 3.91%, to get $104.98. So per year, I'm getting $105, and it varies depending if a company pays quarterly, monthly, or semi-annually. But again, it's calculated on a per year basis. The last section we'll look at, which is kind of Simply Safe selling point, is this dividend safety score. Based on their criteria, they'll give it a rating on if it's safe, borderline safe, or unsafe. What that means is just how likely a company is to continue paying that dividend. As you can see, starting from the bottom, 21% being unrated. That's because a lot of my holdings are ETFs. Since ETFs are made up of a lot of different companies, they don't calculate a safety score since it varies company by company. But for my individual companies, 67% are safe, 9% are borderline, and then 4% are unsafe. I'd like to keep it to around that 70 to 80% being safe so that I can continue to rely on this income. But that 4% being unsafe, we'll touch on this at the end of the video as well, on what that led to and how I got to that point. Looking at some of my top holdings, I'm not going to go over every single company that I've invested in. Again, you do need to do your own research, but for my top holdings here, we'll dive into the spreadsheet. I have the most shares currently in SPHD, which is an ETF that actually pays a monthly dividend. And I have 6 shares, as you can see. Breaks down all the other stuff. We won't get too much into cost per share, price, all that. But my idea with investing this much in SPHD was to get that dividend up to $1 a month. I'm right below that, it's like 94 cents, but with fractional shares on Robinhood, you need at minimum $1 to invest in a fractional share. So my thought was, if I can get this monthly paying dividend stock to pay me at least $1, I can at bare minimum invest a little bit every single month. The second one here is O, which is a REIT, which stands for Real Estate Investment Trust. This is also another monthly paying dividend stock, and it's right at 94 cents as well, so not quite $1. But again, they pay monthly, so I can invest a little bit every single month. I'd say my other favorite companies that I'm investing in and trying to build up more of a position in, the first one here is AT&T. My phone bill is through AT&T, so it's kind of like me getting a little bit of my phone bill back every time they pay me a dividend. Some people don't like AT&T because they actually have quite a bit of debt, but they have a solid dividend, so I'm going to keep investing in them. I'll go down past a couple of these here. Another company I'm building a larger position in is 3M, not just because of everything that's going on and they're a producer of masks and stuff like that. They're actually a company that I started investing in before any of this even happened. It's one of the first shares that I bought, so I'm building up a position in them. The next one is Coca-Cola, which kind of has some controversy as well due to the environment and the waste that they produce. But regardless of that, I think they're a solid company. They pay a solid dividend, and I'm going to build my position in them. And then the last one down here is Johnson & Johnson, which I don't have as big of a position in them as some of the other ones that I just mentioned, but again, I'm building into them. They have a solid dividend, solid company all around. On to the lessons I've learned. As you saw with the dividend safety score, 4% of my stocks have an unsafe rating, which essentially means they're more likely to cut that dividend at some point. So I'd like to consolidate some of those because I did kind of chase yield when I started investing, or I heard about a company that had a high dividend and it looked like it was relatively cheap, and it's kind of burned me. A lot of those have cut their dividends or drastically reduced their dividends, and along with that, the share price has fallen more than half. So I'm hoping they gain a little bit of traction back and go up a little bit more as things kind of level out so that I can sell them off and put them into a more safe dividend company. The other one is to dial in my dollar cost averaging strategy, which I haven't done a great job at. Like I said, if I averaged out how much per month I'm investing, it equal out to $268.50, which is not accurate. Some months I've been able to invest more, some months I've been able to invest less. It's just kind of been what bills we have, what things are coming up, and how we're budgeting. So I'm hoping that I can really focus and set a goal to say, okay, I'm going to invest $100 every single week. So that regardless of what the share price is doing, I'm investing that $100 to stick to that dollar cost averaging. Because right now I'm just kind of taking a look and buying something at fair value. My goal was to get this portfolio to $5,000 by the end of the year. We're already over halfway there with more than half of the year to go, so we're well on track to hit that. But again, I need to dial in that dollar cost averaging so that I can make sure that I do hit it. If I averaged out how much I need to invest a month to hit that goal, it equals out to around $290. So I'm going to try and focus more so I can hit that goal by the end of 2020. With that said, like, comment, subscribe, all that YouTube mumbo jumbo. Thanks for tuning in. Let's continue to grow this beanstalk.